Assalamu alaikum friends, welcome to question number 44 from your SBR revision kit Skye. So the first question, requirement A, the first part of requirement A, we are going to cover financial instruments, your IFRS 9. So the requirement is the directors of Skye wish to know if the above financial instruments should be classified as equity items or financial liability. Now, the previous question to this, which is question number 43, Carson, there was a question on financial instruments, but it was regarding financial asset, debt instrument. As I told you, if they ask on financial instruments, they will ask only one particular part. They will not ask the whole of financial instruments. There it was financial asset. Here, the question is whether it has to be classified as equity or financial liability. This question is repeated under IFRS 9, this type of question. Okay, whether it should be classified as an equity item or financial liability. So from this answer you can take some points which you can write. If you get a similar questions like this, you can use it for your answer for 6 marks. Then second thing is regarding 7 marks. The directors require advice as to the deferred tax implications of the above. This is your IS-12. This is a good question, in fact, because it's covering IFRS 9, all the big topics, the main topics, standards, IS-12, and then we have requirement is advisor directors on how the above transaction should be dealt relating to IFRS. Then part B. Okay. Part B we have regarding conceptual framework. So the first part of B is discuss what is meant by prudence. Okay, and the extent to which prudence is consistent with the fundamental qualitative characteristics of faithful representation. 6 marks. With reference to conceptual framework, discuss the factors that the preparers of the financial statement should consider. This is regarding the preparer. What they should consider when an accounting standard offers a choice of measurement basis. Some standard like IAS 16, PPE, cost model, fair value model, investment property, cost model, fair value model, intangible assets. So wherever choices are there, how the preparers are, what are the factors preparers are going to consider when you account for this? According to conceptual framework, you have to answer for 6 marks again. Okay. Usually, this type of question are done well by the students. According to the examiner's comment also, even the examiners have commented that students do well in this type of question. That means they're good in conceptual framework, and conceptual framework was my first lecture. It's the first topic I've started with, right? Because no uh, topic is complete without conceptual framework, whether it is financial reporting or SBR. Conceptual framework is like the key. You have to know everything is built on around conceptual framework. Whatever the standards you are saying, whatever the IFRS standard or IS, these things are there, it is from conceptual framework only. So you need to know a very thorough understanding. You have to know in and out of conceptual framework, in and out. Okay. But my concern is in the first one. What is meant by prudence? Because this type of questions usually don't students don't expect in SBR level, because they think that the SBR means something, it will be more tough. Then why this is? Because this is something which should be easy for you. The reason is because SBR is also assuming, okay, that you have the knowledge of a financial reporting. So some part of it might come in SBR also. So it's not always that the big things they will ask. They can ask simple definition like this also. What is meant by this word? Questions like this also can appear in your SBR. So in this type of questions, all the students don't do well, because you have been preparing for hard things and the challenging things, and easy things you do tend to neglect. What is meant by this? What is meant by that? So this is also very important. Okay, it carries marks. You should be familiar with the concept of prudence from your financial reporting also. Even though in SBA we are not going through that in detail. It is explained in detail in financial reporting. Okay, so yeah. Now we are going to cover the first one, whether it should be equity or financial liability. So Sky is a publicly limited company which has a functional currency of dollar. It has entered into a number of transactions and they require advice how they should be accounted for. Sky B has B shares in which allow the holders to request redemption at specified dates and amount. The legal charter of Sky states that the entity has a choice whether or not to accept the request of repayment of B shares. They have the choice, who the entity, whether or not to accept the request for repayment of B shares. There are no other conditions attached to the shares, and they have never refused to redeem any of the shares up to the current year. In all other respect, instruments have the characteristics of equity. They have also preference share in issue which are putable by the holders at any time after this one. Under the terms, Skye is only permitted to satisfy the obligation for the preference share when it has sufficient distributable reserves. Local legislation is quite restrictive in defining the profits available from distribution. Okay, so how? One is the B shares, the other one is the preference share. So there are two. If you see the marking scheme, okay, the marking scheme I've not provided. Okay, it's 1 mark for 1 point. So if you see, this answer should be short, and that 6 marks is not just for one. It is divided among two things. One is B shares, other one is preference share. How this debt or equity? It's a common exam topic. If IFRS 9 comes, this question is very common. I've seen it 2 or 3 times. This has been repeated. So that means you have to know two things: definition of equity as well as definition of financial liability. Okay. With standard, not IFRS 9, it is IS 32. Most of the students write incorrect standard here. It's not IFRS 9. When it comes about classification between financial liability and equity, it is IS 32. Because this is regarding presentation, how do you present it? As a equity or as a financial instrument? That's why. So according to the standard, first say what it says. Financial liability means there's a contractual obligation to deliver the cash or another financial asset to another entity. One definition enough. Then equity is any contract which evidences a residual interest in the assets of an entity after deducting all of its liability. That means after you deduct all your assets, liabilities from your asset, whatever is remaining, residual interest is known as equity. Now link this to the B. Okay. In case of B share, do they have obligation? So the main thing when you're looking for contract financial liability or not is the obligation, whether they have the obligation to transfer the cash or financial asset. If yes, financial liability; if no, equity. So in the case of B share, they have no obligation to transfer cash or another financial asset. Therefore, B shares, they should be classified as equity. Okay. Now, if you have more facts to justify this, better put it in your answer. So the fact that they have not refused redemption in the past. See, this is they are linking from the case study, they are bringing these points further. You will get extra points like this if you put. Because it's for 6 marks. Just writing it has no obligation to transfer cash, therefore equity will not give you the full mark. Maybe 1 mark only you will get for saying that. But if you want to collect more marks, you have to write more. So B share should be classed as equity or classified as equity. What was the fact? They did not refuse any redemption in the past. So they has not refused redemption in the past does not cause the B share to be classified as a liability, since this does not create a contractual obligation on Skye. Okay. Just because they didn't refuse any redemption does not mean they have an obligation, contractual obligation. It's their wish. So still it cannot be classified as liability based on that. So 2 marks you will get here. 1 mark you will get from here. Defining financial liability and equity. Or let's say 2 marks only. 2 marks here. 2 marks, 1 defining financial liability, 1 for equity. Another 2 mark, 1 for saying that no obligation to transfer cash, therefore equity. Other one is you are linking to the case study, not refused redemption, but still equity. Another 2 marks is for preferential. So that's how you're going to get the 6 marks. Okay. Preferential, yes, they create an obligation for Skye because of the put option clause in the agreement. They told putable. That means put option clause is there in the agreement. The fact that Skye may not be in a position to satisfy the put option feature because of the fact that they cannot be in a position to satisfy the option. Why? Because of insufficient distributable reserve does not negate the fact that Skye has an obligation. Just because they are not satisfied to fulfill a condition does not mean they don't have an obligation. It's like you, when you're making a loss, you cannot say you don't have an obligation to give interest or the amount of the loan just because you are making a loss. No, you still have the obligation. Whether you make a loss or a profit does not matter. So in this case also it's the same thing. That's why it's an obligation. Okay, so that's how you're going to collect. It's very easy. Now, deferred tax for 7 marks. I can see some numbers given, so some calculation is to be done here. They have a foreign branch which is a function currency of dollar. The branch taxable profit are determined in dinars. First of all, the branch acquired a property of 6 million dinar. The property. The property had expected useful life of 12 years with a zero residual value. Asset was written off for tax purpose over 8 years. Tax rate 30%. Branch and the branch jurisdiction is 20%. In the Skye it is 30%, 20%. So tax rate is different. Foreign branch uses a cost model for valuing its property and measure the tax base at the exchange at the reporting date. They use the cost model for valuing its property and measure the tax base at the exchange rate at the reporting date. Okay, exchange rate has been given to you. A lot of things needs to be done here to get the 7 marks. Exchange rate is there, then the asset, the tax base you have to calculate, your carrying amount of property you have to calculate, compare, then find the deferred tax, whether asset or liability, what you have to recognize. So yeah. See, whatever is written in the tutorial note, it's for your understanding, it's not a part of an answer. Okay. So what you need to understand is that this overseas property, it is a non-monetary item. You first have to identify whether an item is a monetary item or a non-monetary item. Because if it's a monetary item, you translate it at the closing rate. If it's a non-monetary item, like overseas property, and so it is initially translated into the functional currency of Skye at the historic rate and is not retranslated. That's why you need to know why it is monetary or non-monetary. You translate them at the historic rate, opening rate, whatever the rate they have bought at. Initially, you translate at the functional currency of Skye because it's an overseas property. First, you have to translate to the functional currency of Skye, the parent, before doing any adjustment, tax and all. And it is not retranslated. You don't translate it back at the closing date. Whatever initially you have translated, you keep it at that rate only. For non-monetary item like overseas property. The rest all you know. Find tax base, carrying amount, compare, find the deferred tax. Okay. So now, according to IS 12, first say what is deferred tax according to IS 12, because you have to account for deferred tax. Deferred tax is accounted for temporary differences. Differences is temporary, short term. On that you find a deferred tax. Between the financial reporting treatment of a transaction and tax treatment, it's different, right? The way you treat, the way tax authorities treat different, that's why there's a temporary difference. On that you multiply the percentage of the tax and find the deferred tax. For that you will get 1 mark out of the 7. Then second para, so you see it's in different paragraph. 1 2 3 4 5 6 different paragraphs has been used to answer this. Second, we are going to talk about what, before you do any calculation, first talk about what you are going to do. So the property of the overseas branch is written down at the different rates in the financial statements, then it is for the tax purpose. So you have to say whether this thing will give rise to, and how it will give rise to a temporary difference, and whether it will give rise to a temporary difference or not. If it does not give rise to a temporary difference, you cannot find tax. But you will get a difference. You have to get a temporary difference. Otherwise, how will you calculate deferred tax? 7 marks it is. So definitely, yes. It makes sense, right? The temporary difference will be there. So if you see why that temporary difference is there, first you have to start your answer with that. Temporary difference is the main thing. Because the property of the overseas branch is written down at different rate, then it is for the tax purpose. At tax purpose, it is written different rate. Overseas, and the one which you are calculating is at a different rate. Different rates are there for the two different purposes. That's why temporary difference. So because of temporary difference, a temporary difference may also arise if the carrying amount of the non-monetary asset of the overseas branch are translated at different rate to the tax base. That means you are not breaking down at different rates, but you are calculating the carrying amount of that in and they are translated at different rate to the tax base. So let's say 1 mark you will get from here again, or let's say 2 marks, because you have given two things, two reasons why tax temporary difference will be there. So 1 plus 2 3, out of 7 3 marks are gone, now 4 marks. 1 mark you will get from here. What is it? According to IS 12 retranslate, for retranslating now here comes your calculation and all. So properties and non-monetary asset, identify that. First of all, write what type of asset it is. Is it a liability? Is it an asset? If it's an asset, monetary or non-monetary? Non-monetary asset. So according to IS 21, it is translated into Skye's functional currency. Using which rate? Write the rate. It will be translated to what? Using what rate? And then it is not retranslated. You have to write this. Okay. So 1 mark for each. That's how you're going to get the 7 marks. Let's understood. This means the asset would be recorded at this amount. 6 divided by 5, 1.2 million. In dollar, it is given in dirhams. You have to convert it into dollar. 6 divided by 5. Historic rate is 5. That's why. And what is the amount? It is 6 million dinar, they told the property. So 6 divided by 5 to get in terms of dollar. I'm assuming you know the division and multiplication rule. Okay, same currency divide, different currency multiply, because this is same dirham per dollar. That's why you're dividing this 5 by 6 and it is given in dirham. So yeah. Next, you have to use the rule of IS 16. First, use the rule of IS 21, convert, and then use the rule of IS 16 to find the carrying amount. So this requires the asset is depreciated over its useful life. You have to depreciate the asset over its useful life. So that means what will be the carrying amount of the asset after deducting depreciation? It will be 1.1 million. How? Depreciation is 1 month over 12 into 1.2. So from 1.2, deduct this amount whatever you get, and then it will be 1.1. Another way of doing it is simply just take 11 divided by 12. The balance, the remaining after depreciation is 1 month, 1 over 12. So after depreciation, it will be 11 over 12 into 1.2. So that's the second method, faster method of doing. You don't have to deduct anything. Immediately on that, find and find the amount. Okay, carrying amount 1.2. We'll see here. It's 1.2 million. Using that, it will be divided by 12. Why? Because they told you are useful life is 12 years. And 1 year went by. So depreciation will be only for 1 year out of the 12 years. Right? If you want to find for the current, 1 year divided by 12. It's not 12 months, it's 12 years. Now, tax base. So for finding the tax base, another mark. All these are 1 mark. Okay. Tax base will be what? It is 6 dirhams. Correct? First, before you translate using closing rate. Okay. First, you have to find the tax base of the property, which will be 6 into 7 over 8, because for the tax base useful life is 8 years, not 12, and it is 7 over 12. Same how you have done for this 11 over 12, 7 over 8. Otherwise tax depreciation will be 1 over 8, 1 year over 8 years, but after depreciation it will be 7 over 8 into 6, because property is 6 dirhams. So first find it in terms of dirhams before translating the 6. Okay, so it will be 5.25 million. Then using the closing rate 5.25 million, you divide this and find it in terms of dollar. Understood? We'll check this in the other way also. Let's assume that we are taking 6 divided by 5 into 7 divided by 8. 1.05. No, should be done this way. First, find the depreciation using dirham, then translate at the closing rate for the tax base. Okay, you are not supposed to first convert this 6 million dirhams to the dollar and then find the depreciation. No, then you will get a different figure. and then comes your taxable temporary difference. What is it? Here it is 1.1, here it is 0.875. Fine, it's a positive balance. That means there will be deferred tax liability or an asset liability, because carrying amount is more than tax base. So deferred tax balance will be calculated using tax rate. In which country? Overseas country. This also you have to mention. This also you have to mention. Okay, let's give 1 mark here. Sorry, we'll give 2 marks for the last one, because last one, temporary difference and tax rate, two things you are calculating. So yeah, deferred tax balance will be calculated tax rate in the overseas country. Why? Tell me. Because it's an overseas branch, so you have to use their tax rate to find the deferred tax liability, which will be 20%. 30% is yours, but 20% is overseas. So on this temporary difference, apply 20%. This is the deferred tax liability, 45,000, which will increase the tax charge in profit and loss. Understood? When you are taking deferred tax, you have to take the branch tax, 20%. Now, we are coming to part B, prudence, but we have to read this thing. We are over with part A, both the things, okay? 2008 Conceptual Framework was criticized for its many notable omissions. Some omissions were there, that's why it criticized. So one such omission that the 2018 Conceptual Framework addressed. Okay, you have to be thorough with this Conceptual Framework, by the way. 2018. There were some limitations in 2010. That's why this 2018, the latest Conceptual Framework came on. Don't ask me where is 2021 Conceptual Framework. It still didn't come up. Okay, the latest for your exam is 2018 Conceptual Framework, and you should know this Conceptual Framework. During my time, I had to go through, when I gave my SBR exam, it was I think 2015 Conceptual Framework that I had to go through. And obviously 2010 also, the limitations of it. But this time it's 2018. Okay. So one such omission that this was addressed was the role of the prudence. This was not there in the earlier conceptual framework. The revised conceptual framework also details factors to consider when considering a selecting measurement basis. This information should assist the prepares of final statements when applying an accounting standard that offers a measurement choice such as IS 40. Here also there is a choice. So apart from the case, you don't have to refer anything to the case. It is purely knowledge-based questions for both. What is meant by prudence and how the extent it is consistent with the fundamental qualitative characteristics of faithful representation. The prudence concept you have to talk about it for 6 marks. So first is prudence. Easily you can get marks if you are good in this area. This is like your bonus marks and easy marks that you always get in your exams. There are two types of marks. Some are easy marks, easily you can get. Just apply knowledge, get it. Some it's a bit tricky. Some are medium level, like you know the standard you apply, and some are very tricky to get. Like by reading the scenario, you will not understand also what is hidden there. That area needs lot of experience. Lot of practice is needed to crack those type of questions. Easy questions and the medium level questions you can still tackle. For example, the first one was part A, financial liability or equity. That was a medium level. Some you need knowledge and little bit of application in the case study is required. Okay, this one is the easiest because it's purely knowledge, and some type is very difficult because what do I say, it's complex maybe, right? So yeah, 3 levels are there and you need to crack all the 3 levels to pass SBR. But this will really help you if you are not doing so good in the tricky questions in your exam. Don't worry, there are some easy marks or easy questions that you will get in every exam, which will help you to cover up for those mistakes or those things that you have not done well in those questions, which you can do here and get the marks. Because pass rate is 50%, so you just need to cross that boundary, that's it. Now, definition. Prudence is an inclusion of degree. Prudence means you are taking caution now. Okay, when you are exercising some judgments, financial statements, when you're preparing, there are areas where you have to make judgments. So for that judgments, you have to be very cautious, right? You cannot be very relaxed and carefree. You have to be very, very careful. Extra careful you have to be when you're exercising judgment. That is the meaning of prudence, in short. This is related to when you're making estimate. Okay, so prudence is generally taken to mean that assets or income are not overstated and liabilities or expenses are not understated. Why? Because preparers, when they prepare financial statements, what do? They tend to increase their assets or income. They always want to show higher income or assets, overstated. This should not be done. Prudence concept says that. And they tend to show less and less liabilities or expenses. That means they're understating. They should not do this also. That is the meaning of short version of prudence. This much if you know about prudence, it is enough. You don't have to know details and details and details of prudence. Only this much is us. Now apply this to the qualitative characteristics. Okay. So if you see the answer, it is in two different paragraphs. So 1 mark you will get for this. Out of the, how many marks it is? 6 marks? Yes. Rest 5 marks for applying this. So exercise in prudence can lead to what? When you exercise in prudence, increase subjectivity in the financial statements. This can affect your evaluation, the way you evaluate the entity's performance. Because it's hard to evaluate when something is very subjective in nature. When something is very objective, it's very easy because you can easily verify with facts and information and evidence is there. But something which is subjective, your judgment is very hard to evaluate that thing. Based on that, what will be the entity's performance. So, deliberate understatement or deliberate overstatement of financial statements, even in the name of prudence, is non-neutral. Okay, deliberately if you are understating something or deliberately overstating, even if you say it is prudence, you call it that you are doing it in the name of prudence, but it is actually not prudence. You are not being neutral. When you are doing prudence also, you have to be kind of neutral. You cannot deliberately understate something. You cannot understate your assets deliberately, saying that you are being prudent. It's not neutral. There should be a balance. How much you can reduce and how much you can increase. So overstating liabilities and expenses in the current period will lead to higher reported profit. If you overstate your liabilities and expenses in the current period, okay, it will lead to higher reporting periods in the next reporting period. Current period, if you overstate liabilities, next period, it will show higher reporting profit. So because of this, it would not offer a faithful representation of an entity's performance and position. You are not faithfully representing the current position, the actual position of the entity, if you are doing this way. If you're overstating liabilities in the current year just to show higher reporting profit in the next reporting period, maybe just let's assume you are going to receive a bonus in the next reporting period. So what are you going to do? Today, current reporting period, you're going to overstate your liability, which might be okay because you are saying prudence means you should not understate. That means you are overstating. Why? Your intention is to increase your reported profit in the next reporting period because based on that profit, you're going to receive bonus next period. That is not prudence. That is you're manipulating accounting statements. You are not faithfully representing the financial position or the performance that you are supposed to do. So to offer faithful representation, they should be free from bias, the financial statements. Three things are there, no? Faithful representation, free from bias, neutral, and free from error. Right? So did you talk about the neutral part? Yes, we finished the neutral part because financial representation. So this will not be neutral. Now we are talking about free from bias. Financial statement should be free from bias. So preparers have a natural bias towards optimism. What does it mean? Naturally, they just want to show that they are doing good, excellent. Optimistic nature is there. Naturally, that it's a natural bias, natural tendency is there. Whoever prepares financial statements, they always want to show themselves in a good light, optimistic way, right? So often as a result of incentives to report higher profits or assets. Therefore, prudence might counter at this. So here also prudence is not consistent with it. First of all, prudence is not consistent because it is not neutral. You are deliberately understating, overstating in the name of prudence. Second, again, it is not in line with the free from bias because you have a natural tendency to be optimistic. Understood? So, investors are often concerned about financial risk relating to potential losses, and so some form of conservative, conservative certainly has a role to play in financial reporting. Okay, you have to be kind of conservative because investors they want to know about the financial risk. So you cannot be so much of optimistic also. Understood? So these are a few things you can write more or less. Okay. So let's say out of the 6 marks, you will get 2 for neutral, 2 for free from bias, and 2 from here. You are saying what is prudence, or maybe let's say three from here, 1 from here, 3 from here. So 1, 3, 2. You are getting the 6 marks. Measurement. Next thing is measurement. Do you guys remember the requirement or you forgot? It is how, like, what are the factors they should consider when choices are given in a standard. You have to refer this to the conceptual framework for 6 marks again. So when you are answering this question, start with the conceptual framework. What does they say about the measurement? Okay, they say that there are two, conceptual framework identifies that there are two broad measurement. One is historical, one is current value. Start your answer with this: historical cost and current value. Then we'll talk about the measurement basis and all. Okay. So if you say this answer, it's pretty lengthy enough. Okay. So when you are selecting a measurement basis, preparers should ensure that financial information has to be useful as possible. Okay, even though you have an option, you just cannot select the way you want. When you're selecting a method, whether historical cost or current value, it should be done in such a way that useful information is given to the users. Okay, so what should you do for it to be useful? What are the characteristics that are required for our information to be useful? They must be relevant, number one, and second, faithful represent. These two things. So what can they do to maximize this relevance? Because you should, because your requirement is what should they consider when measurement basis is there. So to maximize relevance, what should they do? Prepares. They should see the characteristics of an asset or a liability, because we are talking about measurement basis, whether for asset, whether for liability. That's why to increase relevance, we have to see the characteristics of an asset or a liability first. Character of asset or liability they are measuring. Okay. Also, they should also consider how the asset contributes to future cash flow and whether those cash flows are sensitive to market factors or not. Those things you have to see before taking a measurement basis. Now, depreciated cost. Okay. For example, depreciated cost is unlikely to provide relevant information when an asset is very volatile. Asset has a, like, asset with a volatile market value. The market value changes very rapidly, very volatile for that asset. Then using a cost model, it's not a good, it's not likely to provide relevant information. There you have to use the current value because value changes very rapidly, which that will be true in the short term. So similarly, reporting an asset or a liability at fair value, this is for cost. When you're providing an asset or a liability at fair value, they might not provide relevant information if the item is held to collect contractual cash flow. What does it mean? That means you are having that asset with you. You're not selling that asset. You are keeping that asset, from that you are receiving contractual cash flow, so you can recognize it at cost. That time it is better to recognize it at cost than fair value, because fair value will then not give you the relevant information. See how you are linking this with the relevant information. You came to this point because you should know the useful characteristics of useful information. Relevant and faithful representation. That's why. For it to be relevant, if an asset value does not change frequently, cost model is better. If value changes very rapidly, volatile, fair value is better. Understood? That's why you are linking fair value with relevant information. Now we are going to faithful representation. Relevant information part is over. Faithful representation. So in order to faithfully represent an entity's transaction, consideration has to be given to the measurement uncertainty. How uncertain the measurement is. 2 marks you will get from here, remember, because you are linking the relevant factor to this thing. Sorry, 1 mark each. So yeah, 1 mark, 1 mark. One, you are saying why cost will not be relevant. The other one, you are saying why fair value will not be relevant for relevancy. So out of 6, 1 mark. Now we are talking about faithful representation. So in this case, this arises when estimation techniques are used. When you are using estimation techniques, you can say yes, measurements are uncertain. So if the measurement uncertainty is too high, then information provided by that measurement basis is unlikely to be useful. For example, you cannot measure something using fair value, right? You cannot find the fair value. Then if you are using a fair value model, then that's not a good thing. It's not going to faithfully represent. Why? Because whatever you measure using that fair value model, fair value valuation, it's not going to actually measure. It's not going to be useful because it's hard to find the fair value. A good example is intangible asset. For some intangible asset, maybe for your brand, it's hard to find fair value. Then if you're using a fair value model valuation for your intangible asset for your brand, even though you have the choice, it's not likely to measure. It's not likely to benefit you. It's not likely to provide faithful representation of the actual transaction. Whereas on the other hand, if fair value is easily you can obtain, better to use fair value. Then that measurement basis will be useful. Another mark for that. Measurement uncertainty. So when selecting a measurement basis, what should they consider? Whether the benefits of the information it provides to the users outweigh the cost. Another point is here. So 1, 1, 1, 1 to 4 marks. Cost versus the benefit. Okay. 4. Another mark here. 1, 2, 3, 4, 5 and another mark for the conceptual framework. To link this to the conceptual framework to say historical and current value and say about the relevance and faithful representation, 1 mark. So consideration should also be given to enhancing qualitative characteristics also you have to give. Don't forget those. Okay, what are those 4 enhancing qualitative characteristics? We talked about fundamental characteristics, relevance and reliability. Sorry, faithful representation. Now what about the enhancing qualitative characteristics? Verifiability, timeliness, understandability. Yes, those things, those 4 things. So using the same measurement basis as other entities in the same sector, if you are using the same measurement basis, for example, your product in the market, your competitors are using fair value, better you also use fair value because it will enhance comparability. Okay, because if you are using different, hard to compare. Using many different measurement bases in a set of an estimates reduces understandability. If you are using different measurement bases, too many different, for example, one asset is using cost, the other one is using fair value, it reduces understandability. Even the auditors will not be able to understand or get the actual picture because some are cost, some are fair value. And verifiability. So out of 4, 3 qualitative characteristics we covered here. What are they? Verifiability and understandability and comparability. The other one is timeliness. Okay. So verifiability is maximized by using measurement bases that can be corroborated. That means easily you can verify. For example, for fair value, if you're getting quoted price in the market, there is an active market for your asset. It's easy to verify. But if some some asset where you have estimated that fair value, there is no price, it's hard to verify, then you should not use that fair value model as a basis. Then it's better to use cost model. Here we are not saying whether they have to use cost model of this one. Here we are saying about the factor that they should consider before choosing a model. So these are the factors that they have to choose. They have to see whether it can be verified, they have to see whether it is understandable, whether they can compare things, because we are linking to the characteristics of a conceptual framework, the qualitative characteristics of useful information from conceptual framework. That's why we're talking about all this: relevance, faithful representation, verifiability, all those things you have to link. Understood? So that's it for this question 40. What is this question number 44? See you in the next question. Until then, take care.